as an example, I go into this office building, and when I bought this for $390,000, I didn't just buy the land and the walls. I also bought some carpet. I bought some countertops in the break room. I bought some light fixtures. I bought appliances. I bought a parking lot. All those things I mentioned should be depreciated at a faster rate than 39 years. The IRS knows that carpet doesn't last 39 years. And so they've actually given carpet a 5-year useful life. The challenge is when I bought this building and I handed my closing statement to my tax preparer, they have no idea how much carpet's in this building, let alone the value of that carpet.
Welcome to the Real Estate Reserve Podcast. I'm Jason Balen from Hard Money Bankers, co-host Ian Horowitz from Equity Warehouse. Hopefully everybody's great, having a fantastic day. It's a little bit rainy here on the East Coast, but that's all right. We'll still prevail and we'll make things happen. If this is your first time tuning in to the Real Estate Reserve Podcast, welcome. We appreciate the support. I promise we bring on some great guests that know their stuff that will help you in your real estate careers. If you are a returning viewer, follower, listener, viewer, whatever else I missed, subscriber, we truly appreciate all the support. We couldn't do it without you. And, welcome to the show today. We're going to have a great one.
Yeah, I'm definitely excited because it's a topic that we've talked about before, but a lot of things have changed in the cost segregation industry. We're not going to make it political, but there's some crap going on that we need to know what our politicians are going to do and if they're going to help us or they're going to let it revert back. But before we bring Erik in from Cost Segregation Authority, guys, if you get any value out of this, please feel free to share it. We don't bring in gurus. We're not here to sell you stuff. We just want to bring you good information with good people. And that's what we try to do. So if you get value out of it, the best compliment you could give us is to share the show. Tell your friends about what you've learned. And enough about us. Let's bring Erik Oliver in from Cost Segregation Authority.
Erik, how are you?
Good. How are you guys doing?
Doing great. Tell us a little bit about yourself and how you got into the cost segregation business.
That's a great question. I never grew up thinking I'd be doing cost seg. I grew up in Salt Lake City, Utah. Went to the University of Utah. Got my degree in accounting, not because I liked numbers, simply because that was the quickest way for me to get out of college. I hated writing papers. I hated science, and math always came somewhat easy to me. So it was either a finance degree or accounting degree. Ended up with an accounting degree, never really used it, kind of got into business development and sales right out of college. That job took me to Richmond, Virginia for 12 years and then ended up in Long Island, New York for 5. Was looking to head back to Salt Lake where I had some aging parents and wanted to get back here and came across Cost Segregation Authority. Honestly, at the time, didn't know what it was. I had to look it up. I had invested in a few properties myself at the time, but nothing major, never done cost segregation. Like I said, wasn't even familiar with the term. Once I found out what it was, with my background in accounting and then some business development experience I had, it was a great fit. So I moved out to Salt Lake. Been doing this now for 7 years. Loved every minute of it. It's great working with investors, learning all the different secrets out there, keeping people on top of some of these tax savings initiatives that, again, your typical CPA may or may not understand. It's not because they're incompetent or incapable. It's just a bandwidth issue. And so kind of specializing in this, we're kind of a niche accounting firm where we just specialize in these areas. And it's been a great job for the last 7 years.
Yeah, it's awesome. I think the secret is really being able to understand the tax code. That's the real secret, which it shouldn't be like that. But hey, real quick, before we get into talking about cost segs and things that have changed, like you mentioned that you invested in a few properties. What interested you in investing in real estate to lead you down this path early on in your, I would assume, W-2 career leading up to where you are today?
Yeah, I actually kind of just stumbled upon it when we were living in Virginia at the time. We were looking to move to New York. And we had a house in Virginia and decided to keep that home as a rental property. That's really kind of how I stumbled into it. It was an absolute nightmare. I'll be honest with you. I didn't know what I was doing. I felt like I could do it all myself from, 1,000 miles away in New York. And I learned the lesson real quick that we had to evict some people, and it was not easy not having a property manager, not having run the proper due diligence before we let these people move into this home. And so I learned the hard way, and that it kind of turned me off to real estate for a while, to be honest with you, because I had such a bad experience on that first rental property of mine. But again, I was humble enough to realize that that was my mistake. That wasn't real estate in general. I'd heard so many great stories about people succeeding in real estate. So when we left New York and moved to Salt Lake, started working here, like I said, I had the bug, and working here, I've been to so many conferences, so many trainings, and met so many people who have totally changed their lives by investing in real estate and, getting out of those W-2 jobs. And so eventually that is my goal as well. So we've got a couple long-term rentals, short-term rentals, and then investing in some micro apartments through a syndication here, through some opportunity zone opportunities. So that's what brought me here, but it was really just kind of a sheer luck.
Well, but before the big boss watches this, I guess we better ask him about some cost seg stuff before he quit, right?
Right.
I was gonna say, why don't you try to explain to the audience exactly what a cost segregation is?
Yeah, so cost segregation really is just accelerated depreciation on your real estate assets. So one of the benefits of owning real estate is being able to take these depreciation expenses over the ownership of that property. So normally residential units, anywhere where somebody lives, depreciates over 27 and a half years, and commercial space depreciates over 39 years. So just to make the math easy, I'm here in an office. Let's say I bought this office for $390,000. Essentially, I'm getting a $10,000 write-off every year for the next 39 years. So that means that if I make $110,000 a year, instead of paying tax on $110,000, I'm only paying tax on $100,000 because I've got this $10,000 write-off. Now, I've oversimplified that a little bit just to make the numbers easy. You do have to back out the land value. You unfortunately don't get to depreciate the land, but the idea is you're getting this deduction, an even deduction, or 1/39th of a deduction for the next 39 years. Well, I'm not going to own my building for 39 years typically, number one. Number two, I want my deductions now because I understand the time value of money. I understand inflation. I want my deductions now versus letting the IRS hold on to these for the next 39 years. And so the way we can front load or take some of those deductions in an earlier schedule is by doing a cost segregation study. And that is, we go into this, we'll use this office building as an example. I go into this office building, and when I bought this for $390,000, I didn't just buy the land and the walls. I also bought some carpet. I bought some countertops in the break room. I bought some light fixtures. I bought appliances. I bought a parking lot. All those things I mentioned should be depreciated at a faster rate than 39 years. The IRS knows that carpet doesn't last 39 years. And so they've actually given carpet a 5-year useful life. The challenge is when I bought this building and I handed my closing statement to my tax preparer, they have no idea how much carpet's in this building, let alone the value of that carpet. And so that's where a cost segregation study comes in. Just as the name implies, we segregate the cost into different buckets per se, so that our tax preparer can now depreciate the carpet over 5 years versus leaving it in that building and depreciating it over 39 years.
Yeah, it definitely makes sense. And I think it's hard for people to understand, like, basically what you're saying is we're moving out an HVAC system or a roofing system or even a divider. Like, we use self-storage. Some of the interior walls are considered, well, that's a little different, but equipment, right? Like, you can depreciate those in different buckets. And I think that's where people start to get confused. What are the year buckets that you guys use, and maybe what goes in each bucket so maybe people can understand it a little bit better? And just to be clear, it's not just for commercial assets. It's for all assets.
All assets, yeah. Any revenue generating property is eligible for cost segregation. And so typically what we're doing is we're taking assets that fall in those 27.5-year buckets or 39-year buckets, and we're breaking it up into 5-year assets, 7-year assets, and 15-year assets. And the rest of it stays in that long-term bucket. And so your 5-year assets, those are things like all your interior components. So anything that's inside that can be removed easily without damaging the building or structure. So again, if I take the carpet up, that's not going to damage the building or structure. If I take my appliances out of my duplex, it's not going to damage the building or structure. So that's the easiest way. Now, one thing why cost segregation is so important is it's not just my appliances. If you think of a multifamily, think of all the appliances, the washers and dryers, for example. It's not just the washers and dryers that are a 5-year asset. I have electrical work going into my laundry room, and the only reason I have that plug or that electrical work going into that laundry room is specific for that 5-year asset. So a cost seg study or a quality cost seg study is going to go in and identify how much the cost of that electrical work, and they're going to associate that with that piece of equipment, which is your washer and dryer. Same thing with the plumbing. You've got specific plumbing for your washer and dryer, and that is part of that 5-year asset. And so it's not just the stuff, it's all the stuff that makes that thing a thing, if that makes sense. So your 5-year assets are all your interior components. Your 7-year assets, we don't find a lot of those. Those are kind of like your cable lines, telephone lines, telecommunication, those types of things. And then the other big category is the 15-year land improvements. That's all your exterior components. So everything on the outside. So your curbs, gutters, asphalt, concrete, drainage systems, irrigation, retaining walls, those all get depreciated over 15 years versus 39 or 27 and a half. So when we do our cost seg studies, we usually find, it depends on the asset class, but on an average, it's about 30% of your purchase price minus the land. So you take your purchase price minus the land, that's called your depreciable basis. It's usually about 30% of that depreciable basis that we can recategorize into these other buckets. Now, a big empty warehouse might get 20% segregation. A car wash might get 90% segregation. So that 30% is just kind of an average to give you an idea, but that's kind of how cost segregation works. And that's the buckets that we're looking to put these assets into. Yeah,
that's a great explanation. And I think it's easy to follow. Granted, we have some background in this, and someone might be sitting here saying, well, dude, like taxes are hard enough. And I haven't even brought up, or Jason hasn't brought up bonus depreciation yet, which is a whole nother bucket of crap that we'll get into here in a second. But why would someone go through this like mental pain of doing this? Like, how does it benefit them on their taxes from having to pay the government standpoint? I guess, how do you relate all these buckets back to your taxes now to say, cool, you're getting real-time savings. I don't have to pay the government.
Yeah, no, that's a great question. So think about it this way. We'll use the office example I used earlier, this $390,000 office. If you don't do cost segregation, you're going to get a $10,000 deduction every year for the next 39 years. Whether you own your chances are you're not going to own the property for 39 years, but while you own it, you're going to get that $10,000 write-off. So that $10,000 write-off, to me, if I'm in a 30% tax bracket, I just reduced my taxable income by $10,000, which means I saved, if I'm in a 30% tax bracket, essentially $3,000. So again, that's a great benefit of owning real estate. A lot of people are taking what we call straight line depreciation. Cost segregation says in that first year, instead of taking a $10,000 deduction, by segregating those assets, let's say I find in this office building that's $390,000, let's say I find $90,000 worth of 5-year assets. Well, actually, let's do the math. Let's make it easy math. Let's do $100,000 worth of 5-year assets. Now, instead of me taking a $10,000 deduction in year one, I take that $100,000 worth of 5-year assets and I split it up over 5 years. And now I'm getting, let's say, $20,000 on just those 5-year assets. So now I'm getting a $30,000 deduction in year one. So that $30,000 deduction, if I'm in a 30% tax bracket, that's now a $9,000 tax savings versus had I not done the cost segregation study, I would have got a $3,000 tax savings. So I've just created this tax savings of $6,000 that I'm going to now pay down my debt. I'm going to go reinvest it in real estate. I'm going to put it back into my business. I want this money now versus I'm going to get that money if I own the property for 39 years. But a dollar today is worth way more than a dollar 39 years from now. So give me my money now versus letting the IRS hold on to it. So that's just a very simplified example. Like you said, when you add bonus depreciation, it puts all these numbers on steroids, but that gives you an idea of how you're creating a deduction in those early years, which is saving you tax dollars or creating cash flow in those early years.
Yeah, let's just keep it simple for one more second because I think we're really close to hammering home a great point. So let's say you mentioned you had a W-2 job, you buy a property, you're like, oh, I got to do this cost seg. You do it, but you're already paying taxes and you already get a refund each year. This might be the best example I could think of. But now you do this cost seg, you don't need all this extra depreciation that goes on your taxes. What happens to it? Like, do you get more money back? Do you get to save it? Like, what happens with this extra tax savings that you have if you can't use it in the year that you earn it?
Yeah. So we create these large deductions, and not everyone can use them in the first year. And so the great thing about cost segregation is, one, it just carries forward and it offsets income for next year. So you just keep it in this reserve. And when you have income next year, you can use those deductions to offset that income next year. So you never lose it. It always carries forward, number one. Number two, it can also be used to offset capital gains. So if you have an asset, even if you do a cost seg study on building A, but you go and sell building B, oftentimes, and you have a capital gain on building B, oftentimes you can use the cost seg from building A to offset the capital gains in building B. And so there's a lot of, go ahead.
I was going to say, I just know a buddy of mine, he sold a bunch of stuff. Instead of 1031ing, he had to go out and buy a bunch of stuff and then cost segged immediately to basically do a 1031, which I think is actually a really smart play if you don't want to be jammed into that timetable and you know that you have assets that you can continue to depreciate. So
no, that's a great strategy. I think I've heard people call that the poor man's 1031 exchange, but you're getting the same benefit. You're just not having to go through the exchange process. So no, that's a great strategy.
And I think a good way to look at it, and I don't know if people are following along because it's kind of hard because there's a lot of numbers getting tossed around here. But basically, you're taking all this depreciation that you don't earn over 39 years, you're moving it to the front, and whether you can use it or not, you have it in a savings account. So if you have a windfall from a property that you didn't expect to pay taxes on, or you sell some stocks or any other type of passive income, boom, you have this well of stuff that now you're not paying taxes. Meanwhile, you would have had to wait all 39 years to earn this out, or you'd have to buy X number of more properties to offset your earning potential, which I think that's how we've always viewed it. It's like, just bring the depreciation up front. I'll take it now. Give me a negative AGI. Sign me up. I'll live the Uncle Donald train without having to take $1 billion loss on a casino. And I'll take the negative AGI with all this extra depreciation and go earn income elsewhere. Now we can start selling off assets, not having to pay taxes.
Yep.
Everybody hates paying the government. Does not matter who's in office. Everybody hates it.
That's right. No, you hit it on the head. That's exactly what you do. And it's a great tax planning tool. Cost segregation, having that depreciation, when you have that negative AGI and it's just sitting there, it gives you so many more options when you're looking at your whole portfolio. Some people choose not to sell because they don't want to pay the capital gain. But if you've got this negative number sitting there, you don't have to worry about it. So it just gives you more, gives you and your tax preparers and your tax strategists more opportunities to strategize and come up with ways to save money.
So do most let me think of a good way to ask this question. So what's kind of the over-under size building that makes sense to do with cost segregation? Because obviously there's costs to it and there's headaches and there's time restraints. Like, do you know what that is off the top of your head? Is it like a $500,000 building, a $200,000 building, $1 million building?
Yeah, I have an idea. There's a bunch of variables that go into that,
Sure.
like what your tax bracket is, how long you've held the asset, things like that. But I always recommend, especially with bonus depreciation, which I think we'll get into in a second, I always recommend any asset that has a depreciable basis. So remember, your depreciable basis is your purchase price minus your land value. If that depreciable basis is over $200,000, I would have somebody look at the property to see if it's a good candidate. Doesn't always mean that it will be, based on your circumstances, based on your income levels, other deductions you have, how long you've owned the asset, how long you plan on holding the asset. There's a number of factors that go into that. But anything over $200,000 is at least worth looking at. And most cost seg providers out there will do a free benefit analysis to give you an idea of, hey, on this asset with all these circumstances, here's how much deduction we can get you. Here's what our fee would be. And then you work with your tax preparer to determine, does it make sense for me to move forward? But that's kind of the best advice I can give. Anything over 200,000 is at least worth looking at. Now, it hasn't always been that way. Prior to bonus, I would say it was probably a $500,000 asset because the benefit wasn't as great as it is now with bonus. But now with bonus kind of opened the door to a lot smaller investor to be able to take advantage of some of these cost segregation strategies.
Cool. Let's lead into bonus depreciation and how that works then.
Yeah, so bonus depreciation has been around for a number of years. The government uses bonus depreciation to stimulate the economy. So the idea is they incentivize you to go out and buy stuff. So let's go back in time a little bit. Let's go back to 2017. At the time in 2017, bonus was at 50%. So that means if I go buy a $1 million bulldozer, I would get a $500,000 write-off in year one, or 50% of my bulldozer's purchase price. It had to be a couple things. It had to be a brand new bulldozer. I couldn't buy a used bulldozer, and it had to have a useful life of 20 years or less. So that was the old tax law, 50% bonus. New tax law, Trump comes into office. Trump owns real estate. Trump revises the tax code, makes it very favorable to real estate investors. A couple things happened at the end of 2017 with the Tax Cuts and Jobs Act. First thing is bonus depreciation went from 50% at the time to 100%. So any assets placed into service between 9/27 of 17 and 12/31 of 2022 are eligible for 100%. So let's go back to that bulldozer example. I buy a $1 million bulldozer. I now get a $1 million deduction, or 100% of those deductions, all in year one, which is great. Let's talk about how this applies to real estate, since none of us buy bulldozers here, I don't think. How does this apply to real estate? So remember, the asset has to have a useful life of 20 years or less to be eligible for bonus. So I got to be honest with you guys. I still meet with CPAs, tax preparers today who say bonus does not apply to real estate because real estate is a 27.5-year asset or a 39-year asset. And I said, stop right there. It is not, because you've got a bunch of 5, 7, and 15-year assets within your building, meaning if you do a cost segregation study, we identify those 5, 7, and 15-year assets. All of a sudden, those are eligible for bonus. And at the time, through 2022, it was 100% bonus. So that was the first major change with the Tax Cuts and Jobs Act, is the bonus increased from 50% to 100%. The second change, which I think was even more impactful, was they added 5, actually I think it's 6 words. They added 6 words to the tax code that I'm not even sure the folks in Congress knew were added when they voted for it. So remember, in the bulldozer example, I said it had to be a brand new bulldozer. You couldn't buy a used bulldozer. They added the words to the tax code, new to you, the taxpayer. So now when I buy real estate, I don't have to buy a brand new building. I don't have to build a brand new building. I can buy a used building built in 1980. I buy it today here in 2024. It's new to me, the taxpayer, and now all of a sudden I'm eligible for bonus. So those are the two big changes. Bonus depreciation does have a sunset period. We're actually in that sunsetting period now. So as I mentioned, any assets placed into service between 9/27 of 17, 12/31 of 2022 were eligible for 100% bonus. Anything bought in 2023 was eligible for 80%. Anything you buy this year in 2024, it's 60%, and it goes down 20% every year until 2027, when we're at 0. With the caveat being that there has been a bill pushed through Congress right now as we speak. It's passed the House, it's sitting with the Senate, and they're looking to extend the 100% bonus through 2025, which would be great for us real estate investors. The problem is we are in an election year. It got passed through the House. It's got bipartisan support. I think the Democrats said, listen, we'll pass it if you give us these child tax credits. The Republicans said, hey, we want these business credits. So they agreed on it. The House passed it almost unanimously. It got to the Senate, and there was a few senators who said, hey, hold up. We're in an election year. If we pass this now, this might make Biden look good for this election year. So they're kind of sitting on it. So this is just my 2 cents from the articles that I've read. I actually don't think it's going to get passed before the election. I think we're going to have to wait till after the election. I think immediately after the election, no matter who is elected, because it has bipartisan support, I think it will get passed. But I think we're going to miss out on the 100% bonus for 2023. Because remember, our taxes are due October 15th. The election is not till November. So I just think it's going to make a mess if they try and retro date this back to 2023 tax year. So my guess is that for 2023, it's going to be at 80%. 2024, 2025, I think it will get passed to be 100%. So just keep that in mind. Anything you're buying this year, there is a good chance that you can take 100% bonus on those assets versus the 60%. And now 60% is nothing to shake a stick at. It's still very good. Because we were doing cost seg before there was bonus, when we were just moving stuff from 39 years to 5 years. But now when you add this bonus, it just puts it on steroids. But so we're keeping a close eye on what happens with this bill. Like I said, we're in an election year, so they're kind of not getting anything done in Congress right now. But there's a chance it could still pass, but we'll just have to keep an eye on it.
Yeah, that all makes sense. I'm interested to see one good point you bring up. If you bought something in 22 and you own it today in 24 and you're like, shit, I already got it approved. I can curse on my own podcast. Hey man, I want to do a cost seg because this sounds amazing. Like if I bought it in 22, but I do the cost seg this year, number one, does it make sense? And number two, would I get the 100% in 22, 80% in 23? 60 and 24. How's that work on a look back?
Yeah, so on a look back study, the rules apply to when the building was placed into service. So if you placed it into service in 2022, you get 100% bonus on any of those 5, 7, and 15-year assets that we identify. And the nice thing is even though you didn't do the cost seg study in 2022, you're doing it for your 2023 tax return. We bring all that missed depreciation forward, and you can take that on your current tax return without having to amend. So for a lot of the listeners out there, if you've got a tax liability right now and you own real estate and you haven't done cost segregation, it's not too late to go back. Even if you bought that real estate in 2017, you could have bought it in 2015. You can still go back, do a cost segregation study. You don't have to amend any of those prior year tax returns. There's actually a form. It's called a 3115 change in accounting method. On that form, we're actually checking a box that says, hey, I'm going from an impermissible method of depreciation to a permissible method, basically telling the IRS, hey, I screwed up. I was depreciating my carpet over 39 years. You, the IRS, are telling me that carpet is a 5-year asset. I should have depreciated it over 5 years. I'm going to do that now, and I'm going to fix it, and it's going to create a large deduction. Now, again, the IRS isn't going to tell you you're doing it wrong if you don't do cost seg, because that's just more money in their coffers. But in essence, you're doing it wrong. And so you're fixing it, bringing it forward, and taking it on your current return without having to amend. So those are great candidates for cost seg, great tax planning tools. That's the beauty of cost seg, is you don't have to do it in the year you buy the asset. If you don't have a high income year, just keep the cost seg in your back pocket, do it in a year that you have high income, and take the deductions then. But a lot of tax planning strategies around cost segregation.
Yeah, we kind of just stacked it up. We're like, screw it, the 100% is available now.
Up.
Let's go.
A lot of investors do. They just stack it up. It definitely helps for tax planning. But if you haven't known about it, you can always go back and do it.
Yeah, I know there's going to be some recapture issues at sale and stuff, but I would just look at it as, man, I got a nice negative AGI. Banks hate it, but I don't care. And I can sell off what I want and be able to net it down and not have to pay the government. I think that's what's important. Well, debatable if it's important. That's what personally makes me tick, is not paying the government, because Jason tells me all the time his active income, those big bills that he likes to send to the government, and I laugh because it makes me sick. I don't know how you do it, Jason.
No, you brought up a good point, Ian. You mentioned recapture. We haven't touched on recapture, and recapture can get pretty technical, but it's something that we get asked quite often, and I'll just touch on it if I can, just for a quick moment. But when you sell an asset, you pay two types of tax. You pay capital gains tax and recapture tax, and both of them are calculated based on how much depreciation you've taken. So we're sitting here telling you to front load and take all this depreciation in the early years, and we'll get asked oftentimes, well, that just means I have to pay it back when I sell it. And the answer is not really, and I'll explain why with a quick scenario that I think is easy to understand. So let's say you buy a building for $1 million. You sell it 5 years later for $2 million. When you go to sell it, you're telling the IRS that everything is doubled in value, right? I bought this parking lot, these walls and everything in it for $1 million. I'm selling this parking lot, these walls and everything in it for $2 million 5 years later, and they're going to charge you tax on that $1 million of gain. Well, my land has gone up in value. It maybe has doubled in value. My walls have maybe doubled in value. But my dirty, nasty carpet that's 5 years old, why am I selling my carpet for double what I paid for it 5 years ago? It's stained, it's old, it's dirty. Remember, I mentioned carpet is a 5-year asset. So what's the book value of your carpet after owning it for 5 years? What's the value on books? Zero. So why are you selling your carpet for double what you paid for it and paying tax on it? So when you, in that example where I bought it for $1 million, sold it for $2 million 5 years later, I shouldn't be paying any gains on my carpet. I shouldn't be paying any tax on that carpet. It's fully depreciated. And so, yes, you do have to pay some of it back, but to summarize, you take your deduction today against your ordinary income rate of maybe 35, 40%, depending on where you live. You pay it back at a future date at a 20% capital gains rate, or at most a 25% recapture rate, and then save the spread. And so there's some great tax planning around that as well. Sometimes people think this is just a timing issue, Eric. I get my deductions now, but I got to pay it all back later. And I'm like, no, you pay some of it back at a lower rate at a future date and save the spread. And that's, again, one of the added benefits of cost seg.
Huh. Yeah, that's interesting. I never really thought of it like that.
Yeah. It's a confusing subject, but if you remember anything from what I just said, don't sell your dirty, nasty carpet for more than you bought it for, and then give us a call and we'll walk you through if there's an opportunity to save taxes there. But that's the idea.
That makes a lot of sense. Actually, I can almost follow that along. So it's interesting. So you see, your suggestion is call you when you buy it, call you when you sell it. And I'm assuming when you make improvements, you might even want to call too, right? Because there's multiple tax savings all through it that I think a lot of real estate investors miss out on. I know we've done some lighting stuff that, we've gotten credits for the stuff we've thrown out. We've gotten credits for energy. I know you guys do some of that stuff as well.
Yeah. You hit it on the head. So one of the added benefits of doing cost seg is, like you said, when you dispose of any component of your building, when you know what that old component was. So like if you dispose of your air conditioners and they still have a book value of, let's call it 10,000, when you dispose of those or get rid of those, you get to write that $10,000 off as what they call a partial asset disposition, which allows you to take more deduction and pay no recapture tax on it. And then you get to depreciate your new air conditioner when you put it on. So again, one of the added benefits of changing out or having a cost seg study, when everything's line itemed, when you actually do your improvements, you can then take advantage of those partial asset dispositions.
Yeah, no, it's definitely makes sense. I mean, dude, there's so much information. We could probably go on for hours, and I could probably keep asking you questions. Like, well, this doesn't make sense. That doesn't make sense because the IRS tax code does not make sense.
No.
But that's a political podcast for another time and a lot of beers or whatever, whatever makes you move after hours. Erik, where's the best place people can find you on the internet if they want to reach out, they want to learn more about your company and, maybe even have a look at a cost segregation study?
Yeah. Best place is our website. So it's just www.costsegauthority.com. On that website, you can find my contact information, my email, my phone number, as well as there is a place where you can input some information on your building if you would like us to give you a benefit analysis. Like I said, most cost seg providers will always do a benefit analysis before we ever engage you to do a study. We want to know what the expected tax savings is going to look like. We want to know what the fee is going to be for the study so that then you can make an educated decision with your tax preparer to see if it makes sense. So that's definitely the best way to get a hold of us. Again, it's just costsegauthority.com.
Yeah, we'll get that in the show notes. Definitely appreciate this. One question we do like to ask before we let everybody off the hook is, I don't know if you're a book guy, podcast guy. Is there one book or podcast that you would like to suggest to everybody or that you've been enjoying recently?
Well, other than this podcast, which I guess if they're listening to this, they've already heard of this podcast. So other than this podcast, I would say a great book is Tax-Free Wealth by Tom Wheelwright. I know people don't like reading about taxes or talking about taxes. It can be a boring topic at times, but it's so important as you build your portfolio. It's not what you make, it's what you keep. And a lot of people aren't keeping enough. They're overpaying in taxes because they're not aware of some of these strategies. And that book, Tax-Free Wealth by Tom Wheelwright, it goes through, it's a very easy read. It's something you can read in a weekend. Very relatable, even if you don't have a tax background, it's very relatable, but it's called Tax-Free Wealth by Tom Wheelwright. It's got some great ideas, some great strategies in there on how to, again, I think he mentions in there, like the tax code, it's thousands of pages, but it's only like 2 pages on what you pay tax on Everything else is how to not pay tax. And so just trying to understand that is important. So that's a great book. Again, it's Tax-Free Wealth, or Tax-Free Wealth.
That's through the Rich Dad Poor Dad series, right? With Robert Kiyosaki.
I think Tom Wheelwright, if I'm not mistaken, I think Robert Kiyosaki's CPA, so he does all the tax work for Robert.
I read that book recently. That was good. You are right. It's pretty easy to follow along on some of that stuff. Nice.
All right. Well, Erik, we appreciate you guys. Go check them out at costsegarauthority.com. We'll get everything up in the show notes. We appreciate it. If you guys got any value out of this, please, again, feel free to share it. And Erik, we appreciate having you on, and we'll catch you guys on the next one.
All right.
Thanks for tuning in to the Real Estate Reserve podcast. Do us a favor and like, comment, and share our broadcast. It helps the algorithm and helps us spread the word too. Till next time, thank you for tuning in.